Gold's 17% drop this year is not exactly what our first guest today has been calling for. Peter Schiff of Euro Pacific Capital is one of the world's preeminent gold bugs. It's my pleasure, as always, to welcome him back to the show. Hey, Peter.
Hey, you know, you're talking about investors' demand for gold going down. I would disagree because, you know, I own a gold company, too, Euro Pacific Precious Metals, and we've never had more demand from our clients in the history of my company than we have now. I would say that speculative demand is what went down. I think a lot of people who came late to the gold rally were speculating in gold. They were simply buying it because the price was rising. They wanted to hop on that train. They used ETFs. They used the futures market. So I think the speculators have been flushed from the market in this pullback, but the investors, they're still there because all the reasons that they've been buying gold for the past 10 or 12 years, those reasons have never been stronger, and so investor demand continues. We flushed away the speculative demand, but I think the speculators will come back in the next rally.
All right. Well, Peter, let's step back for a second because you kind of jumped in there on the conversation that we were having, and I definitely appreciate your opinion on that. But I want to talk about the gold price that we're looking at right now, 1383.6. That is the price that we're looking at this point. We've had you on the show multiple times before. You've said that gold is going to skyrocket. You say it's going to be a bumpy ride, and you can't tell us exactly how we're going to get there. But tell me today, Peter, why have you gotten it wrong?
I don't think I have gotten it wrong. You just said I said it would be a bumpy ride, and it's been bumpy, but I've been on this ride since gold was under $300 an ounce. So it's not like, you know, gold is down from that point. It's off its highs. But I think what's going on right now is you've got a false narrative out there that the U.S. economy is improving. It's not. All the data points have been negative. We had a deluge of negative data came out today. The only evidence of a rebounding economy is the stock market going up or the real market going up. But that's not because the economy is sound. That's because of all the cheap money created by the Fed. That's the same reason that stock and real estate prices were going up in 2006 or 2007. It is a bubble. The economy, meanwhile, is actually getting worse, and all this talk about the Fed getting ready to take away the punch bowl is all talk. They're going to spike it even more. They're going to up the size of QE, but people who are speculating on an early end are getting it wrong. Gold is going through a correction. All bull markets have corrections. It is a buying opportunity.
Okay, Peter, I want to transition on to another point and talk about Japan for a moment, because you sort of believe that their easing efforts are going to fail. But today, Japan's first quarter GDP growth, it actually came in at an annualized rate of 3.5%. So what do you think the chance is that the Japanese can actually create some real growth here?
Well, that was, I think, the nominal number. So I think if you back out inflation, it was maybe half of that.
Okay.
But, yeah, I mean, in the very short term, you know, you get a little bit of a boost, just like you shoot yourself up with heroin, and it feels good initially. But you got to think about the long-term consequences. This is a disaster for Japan. Japan doesn't need more inflation. That's not what's going to help the economy. In fact, stable prices or slightly falling prices, if you're lucky enough to have that, are great for your economy because as prices come down, consumers can buy more stuff. You create purchasing power when prices go down. Now that prices are rising in Japan, and they are rising for all sorts of things, that's going to make the average Japanese poorer. But the big problem that's going to hit Japan, I think, like a tsunami, is going to be you have all these Japanese citizens that have been sitting on a pile of Japanese government bonds. They need to sell those bonds. They need to get out of Dodge. They need to get rid of their yen and buy something, anything, stocks, gold, foreign stocks, foreign bonds. And when this happens, interest rates are really going to move up in Japan. They're already moving up. Look at those JGBs, but they got a lot higher to go. But the Bank of Japan cannot afford to service that debt. Maybe if it wants to liquidate its stockpile of treasuries, it would be able to do it for a while. But if it doesn't want to do that because it wants to keep artificially debasing the yen, you've got a real crisis.
So link that back to gold for me.
Excuse me?
Link it back to gold for me.
Well, that's bullish for gold because the Bank of Japan is going to have to print ever-increasing quantities of yen to try to prop up that bond market, and that is bullish for gold. And, you know, all this cheap money, and you've got other central banks. Now, Australia just cut rates, despite the fact that the economy doesn't need a rate cut, because they're trying to keep the Australian dollar from rising against the yen. South Korea is doing the same thing. Look at what they're doing in Scandinavia. Everybody is trying to debase their currency in a currency war to compete with Japan, to compete with the United States. All of this